Hi, ladies and gentlemen. Welcome to another episode of Global Economic Perspectives with Raymond. I am your host, Raymond Chan. Over the past few months, global financial markets have been flooded with speculations surrounding a new wave of megatech IPOs. Companies associated with artificial intelligence, aerospace technology, data infrastructure, and frontier computing are suddenly becoming the hottest targets on Wall Street once again. From OpenAI to Anthropic, and even renewed discussions surrounding a future listing of SpaceX, investors are witnessing something extraordinary. Private technology giants reaching valuations previously reserved only for sovereign economies or century-old industrial titans. OpenAI's valuation has reportedly surged beyond US $300 billion in secondary market discussions. Anthropic has been aggressively raising capital at increasingly higher valuations backed by major institutions such as Amazon and Google. Meanwhile, SpaceX continues to dominate the private capital market with an valuation exceeding US $350 billion, making it one of the most valuable private companies in history. But the real question is this: why are so many technology unicorns suddenly preparing to go public now? Is it the beginning of a new technology supercycle? Or are we once again entering another dangerous era of speculative excess similar to the dot-com bubble of the millennium? And more importantly, should investors participate in these IPOs or wait for the excitement to cool down? In this episode, let us explore the deeper political, financial, and economic force behind this global phenomenon. Why are these technology unicorns rushing towards IPOs this year? To understand this IPO wave, we must first understand the macroeconomic situations behind it. For almost 3 years after the aggressive global interest rate hikes initiated by the Federal Reserve System and other major central banks, global venture capital markets enter what many investors described as a funding winter. Private capital became expensive, overvalued. Institutional investors became cautious. Technology valuations collapsed. Many startup companies that were once celebrated as future disruptors suddenly faced survival pressure. However, 2025 and 2026 changed the narrative dramatically. The rise of generative AI has completely transformed investor sentiment. Artificial intelligence is no longer viewed merely as another software trend. It is increasingly being perceived as a foundational economic infrastructure comparable to electricity, the internet, or even cloud computing. And this changed everything. For the first time since the smartphone revolution, global capital markets believe they are witnessing the birth of an entirely new economic platform capable of reshaping productivity, labor markets, military systems, finance, healthcare, entertainment, and even geopolitics. And that belief alone has triggered an unprecedented flow of capital into AI-related firms. But there is another important factor behind the IPO rush: liquidity pressure. Many early-stage investors, venture capital firms, sovereign wealth funds, and private equity institutions have held positions in these unicorns for years without a viable exit opportunity. Remember, during the low interest rate era between 2019 and 2021, enormous amounts of capital flood into private markets. Investors accept extremely high valuations under the assumption that IPO windows would remain permanently open. Then inflation arrived, interest rates surged, and IPO markets frozen. As a result, trillions of dollars became trapped inside illiquid private investment. Now that the market sentiment toward AI has recovered, original shareholders are finally seeing an opportunity to unlock liquidity at premium valuation. In other words, this IPO wave is not only about optimism, it is also about timing. Many funds are under pressure to realize returns before the next economic slowdown emerged. Another key reason is geopolitical competition. The United States and China are increasingly engaged in a technological Cold War centered around semiconductors, artificial intelligence, aerospace systems, and quantum computing. Technology companies today are no longer just commercial enterprises. They are strategic national assets. A company like SpaceX, for example, is deeply connected to satellite defense systems, military logistics, and national communications infrastructure. Similarly, OpenAI and Anthropic are becoming critical players in the race for AI dominance. Going public allowed this firm to raise enormous amounts of capital to fund the next stage of infrastructure expansion, particularly AI data centers, advanced chips, energy systems, and global cloud networks. And this is extremely capital intensive. Training next generation AI models may eventually cost tens of billions of dollars annually. And only public markets possess that scale of funding capacity. Therefore, the IPO rush reflects not just investor enthusiasm, but also an escalating global race for technological supremacy. Is this a healthy phenomenon or a dangerous bubble? Now we arrive at the most controversial question. Are these valuations justified? Or are we simply witnessing another speculative mania? The answer is complicated. On one hand, there are real technological breakthroughs occurring today. Unlike many internet startups during the dot-com bubble, modern AI companies are generating real enterprise demand. Corporations worldwide are rapidly integrating AI into customer service, software engineering, hardware engineering, cybersecurity, and even legal analysis, financial modeling, advertising, and healthcare diagnostics. Productivity gains are becoming measurable. The commercial applications are real. This is not pure fantasy. However, markets are also behaving with extraordinary excitement. And history teaches us something very important. When investors begin believing that this time it's different, risk usually becomes high but invisible. The current AI investment boom contains several characteristics companies seen during historical bubbles. First, valuations are expanding much faster than revenues. Second, investors are pricing companies based on future dominance rather than current profitability. Third, capital is concentrating into a small number of story stocks, perceived as untouchable winners. And fourth, retail investors are increasingly entering markets due to fear of missing out. We saw similar psychology during the very boom, the internet bubble, the cryptocurrency mania, and even the electric vehicle surge. However, this does not necessarily mean AI will fail. In fact, the underlying technology may indeed transform the global economy. But transformational technologies and speculative bubbles often coexist simultaneously. The internet changed civilization, yet countless internet stocks still collapsed after year 2000. That is an important distinction investors must understand. The biggest risk today is not whether AI matters. The biggest risk is whether current valuations already assume decades of future perfection. For original shareholders and insiders, the temptation to monetize positions at historically elevated valuations is obvious. If you are an early investor sitting on 1,000% return, and markets are offering unprecedented liquidity, the rational financial decision may indeed be to partially cash out through IPOs. and that does not automatically imply the company lacks future growth. But it does suggest insiders recognize current market enthusiasm may not remain permanent forever. And another issue is competition. Right now, investors are behaving as though only a handful of AI companies will dominate the future, but technological leadership changes quickly. Today's market leader can become tomorrow's forgotten platform. In the AI sector, barriers to entry are high, but not undefeatable. Open source models are improving rapidly. Governments may impose regulatory restrictions. Energy costs may rise dramatically, and profit margins could compress as competition intensifies. Therefore, while the AI revolution itself is probably real, the valuation environment surrounding it may already contain bubble-like characteristics. And now, let us examine the bigger picture. Can these technology giants sustain the growth over the next decade? The answer depends on three critical forces. First, energy. AI expansions requires enormous electricity consumption, and modern AI models demand massive computational power. Data centers are becoming the new factories of the digital economy. This means future AI growth will increasingly depend on energy availability. Countries capable of securing stable electricity supply, semiconductor manufacturing capacity, and advanced cooling infrastructure may become the next technological superpowers. And second, geopolitical fragmentation will reshape the industry. The United States, China, Europe, and the Middle East are all attempting to establish sovereign AI ecosystem. And this means future technology companies may operate under increasing political influence. Regulations, export controls, national security reviews, and digital sovereignty policies will become central investment considerations. Third, productivity. The long-term sustainability of AI depends on whether it generally improves economic productivity. If AI substantially increases global productivity, corporate profits could expand dramatically. But if AI mainly replaces labor without generating sufficient new economic demand, societies may face rising inequality, unemployment pressure, and political instability. And this is why governments worldwide are simultaneously supporting AI development while also worrying about its social consequence. AI may become the defining political economic issue for the next 20 years. Now, let's discuss which sectors may become the market's new favorites. I believe there are several major categories. First, AI infrastructure providers. Second, semiconductor and advanced chip manufacturers. Third, cybersecurity and digital defense firms. Fourth, energy technology companies supporting data center expansions. And fifth, robotics and industrial automation. Finally, sixth, companies integrating AI into traditional industries such as healthcare, finance, logistics, and manufacturing. The next decade may not simply produce technology companies. Instead, every industry may eventually become an AI industry, and that changes how investors should think about the future. So, ultimately, what are we witnessing today? This is not merely another IPO cycle. This is a global capital reallocation event driven by artificial intelligence, geopolitical rivalry, and the restructuring of the world economy. Some variations may indeed be excessive. Some IPOs may disappoint. And speculative behavior is clearly re-emerging in financial markets. But put the hype aside, there is also a deeper reality. AI is becoming a foundational economic force, The companies leading this transformation could shape not only financial markets, but also labor system, national security, industrial competitiveness, and global political influence for decades to come. The challenge for investors is therefore not simply identifying exciting technology. The real challenge is distinguishing between temporary market excitement and sustainable long-term economic power. Because in every technological revolution, fortunes are created, but bubbles are also born, and history has repeatedly shown us that the line separating genius from speculation is often far thinner than investors realize. Thank you for watching the Global Economic Perspectives with Raymond. Please comment below if you have any thoughts. I'll see you next time. Bye-bye.